Accrued interest. Okay, our earlier description of a bond as an IOU was very simple. An investor loans money to an entity, he'll be paid back at maturity, and he'll receive a stated amount of interest for loaning the money. Now, for this accrued interest example, let's assume that you own a 6% bond and it's got a maturity of December 1st. And let's assume you've been receiving two interest payments each year. You're receiving one in June and one in December. Now you decide you want to sell your bond. Now you're being paid every June 1st and every December 1st. Now in the current year, you were paid your regular interest payment on June 1st, but you sold your bond on Tuesday, August the 12th. That is, you sold your bond after being paid in June, but before being paid in December. Now, the bond issuer is going to pay interest in December to the bondholder at that time, which is going to be your buyer. So therefore, the only way that you can receive your interest owed is to charge the buyer for the interest that the buyer is going to be paid in December from the issuer. Again, it would be nice if someone was calculating, okay, you held the bond for these 70 days, so we're gonna figure out the interest for those 70 days and cut you a check, and then we're gonna turn our attention to your bond buyer, and we're gonna start counting the days that he's been owning the bond since the time that he purchased the bond from you. But that's not the way it works. Again, the only way that you can receive your interest owed is to charge the buyer for the interest that the buyer is going to be paid on the next interest payment date from the issuer. So again, if you'll take a look at the illustration in the book, we've got our June payment. You held on to the bond, you sold the bond, and then the December payment comes out. The entire 6 months is going to your bond buyer. So what we've got to do is we've got to figure out for that period that's highlighted in yellow, the period that you held the bond and earned interest, we've got to figure out how much interest is due to you. Now the formula for interest is principal times rate times time. Now we know the principal amount, it's the par value of $1,000. We know the interest rate, it's 6%. However, we've got to follow a few rules to find the time value. Now, accrued interest is calculated on the basis of a 360-day year, with each month having 30 days. This is true for both corporate bonds as well as municipal bonds. And accrued interest is calculated from the last interest payment up to but not including the settlement date. Now your bond has a par value of $1,000 and it pays 6%. You sold your bond on Tuesday, August the 12th, between the two coupon dates. Now what we're going to do is we're going to analyze the months and then the days. The step number one is to find the interest payment dates. Now interest is paid in intervals of every 6 months based on the maturity date. Now our maturity date is December 1st, so the interest payments are going to fall on June 1st and December 1st of each year. If you take a look at the illustration, you simply want to write out January, February, March, April, May, June, skip a line, and continue July, August, September, October, November, December. Now, since December 1st is the maturity date, you want to circle both June and December. Those are going to be our interest payment months. And we're going to solve for the interest between the period of June 1st and a trade date of August the 12th. So you can see in red in the next illustration, June, July, and August. Now next what you're going to do is you're just going to list out the months that the bond was held from the last interest payment date. So for June, we're going to have a full 30 days. And we also know that July is going to consist of a full 30 days. However, we've got to apply the special rules to August. And the easiest way to do this is to simply write out a full week, beginning with the trade date, remembering that corporate and muni transactions settle in 3 business days. So what we're going to do is we're just going to write a full week, Tuesday, Wednesday, Thursday, Friday, Saturday, and then we're going to count from the trade date. You can see it's there highlighted in red, Tuesday the 12th. Up to but not including the settlement date simply means up 3 from the trade date and then move back 1. So the trade date was Tuesday, August the 12th. It's highlighted in red. We're going to move up 3 days. So we're going to move up Wednesday, Thursday, and Friday. And then we're going to pull back 1. We're going to land on Thursday the 14th. So now we know that August is going to consist of 14 days. So you're going to add June with 30 days, July with 30 days, August with 14 days, for a grand total of 74 days. So our formula of principal times rate times time is going to be $1,000 par value times 6% times 74 divided by 360. We're going to arrive at $12.33. So we would charge the buyer the price of the bond plus $12.33 to compensate you for the interest that's due you. Okay, a variation to this question. They might show you that the maturity date is not on the 1st of the month, but the 15th of the month. Now the question would become similar to this. Assume you purchase a 6% bond at par with a maturity of December 15th. Now the bond was sold again on Tuesday, August the 12th, which is between coupon dates. And again, interest is paid in intervals of every 6 months based on the maturity date. Now we're going to follow the exact same process, but we're going to account for the mid-month maturity. So we're going to analyze the months, then the days. Step number 1 is to simply write out your calendar, January, February, March, April, May, June. Skip a line, July, August, September, October, November, December. Now since the maturity date is December the 15th, the interest payments are going to fall on June the 15th and December 15th. And again, we're going to solve for the interest. This is going to be between the period of June the 15th and a trade date of August the 12th. So next we're just going to list out the months that the bond was held from the last interest payment date, and this is where the difference comes into play. Now interest is calculated from the last coupon payment date up to but not including the settlement date. So when you see a coupon date of 15, you've got to count the coupon date to allow for 16 days remaining in the month. 15 equals 16 for the first month. Make this a hard and fast rule. Now what I mean by this, we've got to count June 15th through June 30th. You're counting the 15th through the 30th. It's going to wind up giving you 16 days in June. So we know June's going to consist of 16 days, and we also know that July is going to consist of a full 30 days. However, again, we've got to apply the rules above to August, and the easiest way to do this is to write out a full week, again, beginning with the trade date. Then we're going to count from the trade date to find the number of days to plug into August so we can reach the total. Now, up to but not including the settlement date simply means you're going to count up 3 from the trade date and back 1, just as we did in the previous example. So the trade date was Tuesday, August the 12th. It's highlighted in red. We're going to move up the 13th, 14th, and 15th, and then we're going to pull back 1, and again we're going to land on the 14th. So we now know that August is going to consist of 14 days. So you've got June with 16 days, July with 30 days, in August with 14 days for a grand total of 60 days. So therefore, our formula, principal times rate times time, the principal is $1,000 times a rate of 6%, and our time value is going to be 60 over 360. You're going to arrive at $10. So you would charge the buyer the price of the bond plus an extra $10 to compensate you for that interest. Okay, here's another variation that they can throw in there. They could throw in a weekend involved in the settlement, and the question would become similar to this. Assume you purchase a 6% bond at par with the maturity of December 15th. Now, the bond was sold this time on Thursday, August the 14th, between coupon dates. And again, interest is paid in intervals of every 6 months based on the maturity date. As you see, we've got a maturity date, again, of the 15th of the month, December the 15th. We're going to do the same exact thing. We're going to analyze the months and then the days. The first step, you're just going to list out the months. Now, since our maturity is 12/15, we're going to circle December as well as June. And we're going to solve for the interest between the period of June the 15th and a trade date of August the 14th. So again, you simply want to list out the months the bond was held from the last interest payment date. And interest is going to be calculated from the last coupon payment date up to but not including the settlement date. Now, when you see a coupon date of 15, again, that hard and fast rule, we've got to count the coupon date because not only are we being paid, but we're also holding the bond and continuing to earn interest on that day. So that's going to give us 16 days remaining in the month from the 15th through the 30th. So we know that June's going to consist of 16 days. We also know that July is going to consist of a full 30 days. And we're going to find August by counting from the trade date up 3 and back 1. Again, that's up to but not including the settlement date. It simply means up 3 from the trade date and then back 1. Now this time we're assuming a trade date of Thursday, August the 14th. So as you can see highlighted in red, I've got Thursday the 14th. We're going to move up 3 business days. So what we're going to do is we're going to count Friday the 15th as day number 1. We're going to pass over the 16th and 17th for the weekend, Saturday and Sunday. Then we're going to continue to count Monday as the second day. And Tuesday the 19th is going to be our 3rd business day. We're going to pull back 1, and we're going to land on Monday the 18th. So we now know that August will consist of 18 days, and you can complete your monthly chart. So our formula of principal times rate times time is going to be a principal amount of 1,000 times a rate of 6% times 64 divided by 360, $10.67. You would charge the buyer the price of the bond plus $10.67 to compensate you for the interest that's due you. Finding accrued interest on government bonds. Now again, the formula for interest is simply principal times rate times time. And to find the accrued interest, we know the principal amount and we know the rate. However, this time we've got to follow a few different rules to find the time value for government bonds. The reason being, accrued interest for government bonds is going to be calculated on the basis of a 365-day year and the actual days elapsed. Now, accrued interest is calculated from the last interest payment up to but not including the settlement date. However, with government bonds, they settle in only one day. So we'll use a similar example. Let's assume you purchase a 5% government bond at par with a maturity of December 1st. Now the bond was sold on August the 12th, and again, this is between coupon dates. Now we're going to analyze the months and then the days. The first step is to, again, find the interest payment dates. Now, since our maturity date is December 1st, the interest payments are going to fall on June 1st and December 1st. We're solving for the interest between the period of June the 1st and a trade date of August the 12th. So we're going to list out the months that the bond was held from the last interest payment date. So we know that June is going to consist of a full 30 days. We know that July is going to consist of a full 31 days because we're using the actual calendar days elapsed. However, we're going to have to apply the rules above to August. And the easiest way to do this is to, again, write out a full week beginning with the trade date, remembering that government bonds settle in one business day. So we've got our trade date. It's Tuesday, August the 12th. We're going to move up one day to Wednesday the 13th, and then we're simply going to pull back one day right back to Tuesday the 12th. So now we know that August consists of 12 days, and we can complete our monthly chart. June has a full 30 days, July has a full 31 days, and August has 12 days, for a grand total of 73 days. So therefore, our formula of principal times rate times time is going to be a principal amount of $1,000 times a rate of 5% times a time value of 73 divided by 365 equals $10. You would charge the buyer the price of the bond plus $10 to compensate you for the interest due you.